Tim Berkwin here, co-founder of TraderInterviews.com. Here's a few highlights from a recent interview I did with a full-time, at-home trader, Charles, who makes his living trading the S&P E-mini contract. Like most interviews you'll find on the site, I start with the big picture and we quickly make our way into the specifics of how he finds good trades. Listen in as he talks about how he gathers a broad picture of the markets before diving into his daily trading.
Cycles. I really pay attention to cycles. You have the seasonal cycles. For instance, mid-March to mid-May is typically a bullish cycle in the market. If market structure, meaning if you're starting to get higher highs and higher lows around mid-March, high probability trades would be in a long direction during that period. Then you got your monthly cycles, and of course most people know about the end of the month bullish cycle when a lot of mutual funds and retirement funds are buying into the equity market. And then you have a shorter-term cycle that I pay attention to, first discussed by George Douglas Taylor back in the 1950s. Back then he called it a 3-day cycle, and back then maybe it was really a 3-day cycle, but nowadays it's more like a 2 to 5-day cycle where just quickly you'll have a strong trend day and then you'll have several days of price consolidation where the market just kind of bounces around in a small range. And then you have another trend day and it goes and finds another equilibrium zone to play in. So that's the type of cycle I pay attention to. Mm-hmm. So you need to know the difference between are you in a trend day or are you in a day where the market's just going to bounce around in a small range. You really need to pay attention to that. What type of market am I going to be in today?
Next, I talk with Charles about equilibrium zones, how he finds them, how he maps them on his charts, and then how he uses them as support and resistance zones. We then talk about the time frames he watches closely. We also talk about how he uses the NYSE tick indicator to look for changes in the short-term trend.
Well, first what I do is on a 30-minute chart, I look for price clusters or those equilibrium zones. And those zones will have well-defined upper and lower limits. The upper limit will be resistance and the lower limit will be support. And you'll find that the market will test both the upper and lower limits throughout the day. Then I go to the 1-minute chart. The 30-minute defines the overall support and resistance prices. And then I go to the 1-minute chart for timing. On the 1-minute chart, I have the ES futures and I have the New York Stock Exchange tick indicator. And I use the tick indicator to show me where the market may be changing momentum from a bearish phase to back to a bullish phase and vice versa.
Charles then talks about what other specific indicators he uses and how a few things put together draw a picture for him and shows him where his entry points will present themselves. As all great traders do, Charles has mastered the ability to have the market tell him when it's time to trade and when it's time to just sit back and watch.
On my tick chart, I have a Bollinger Band, a 50-period Bollinger Band, and the standard deviations I used are 1.5. Plus 1.5 and minus 1.5 standard deviations around that 50-period moving average. And I look to see when it's hitting support. I then start looking at the tick to see if it starts trending back up, showing me that there's buyers entering the market. Also, I would look at see if there's what I call a bullish divergence. In other words, futures making a lower low while the tick is making a higher low. That would be a bullish divergence. That means that the futures overreacted somewhat, and the momentum of the equity market is really changing back to a bullish phase. As the futures is testing that support level, it will tend to test that support level several times. And when it's doing that, it will make a pivot high. And then as it's finished testing support, it will trade past that pivot high. And then it will come back down one correction. I call that the first correction after the bounce. It's usually on that first correction that I will enter a long trade. When you get that first correction, I look for the tick to trade back down to between minus 200 and minus 400 and hopefully hit that lower standard deviation band. If it goes that far and hits that lower standard deviation band, that is when I enter my long trade.
I then asked Charles to talk about how he was able to go from being a trader where he was, for the most part, guessing with each trade, to becoming familiar enough with the E-mini market to know intuitively where it was headed next. He also talks about something he watches as a leading indicator.
It really comes down to training your brain to see the opportunities in the market. Because I can remember when I first started, I would look at the E-mini futures chart, let's say like a 5-minute chart, and it just looked like mumble-jumble to me. It would go up, and then for no reason, turn around and go down. I could see no reason why the market would just kind of jump around like a jelly bean. But today, when I look at a chart, I can see where the market has potential for changing direction, and I know why it's changing direction. You start to see the organization and the chaos. And testing. How does the futures market react with certain stock exchange tick movements? How does it react to the New York Stock Exchange advanced decline line? You'll find, for instance, the New York Stock Exchange advanced decline line will typically lead the futures market by a day or two. In other words, the futures market will, if it trades down, it will start forming a bottom. But before it trades up from the bottom, I'd say a good day to 2 days, the advanced decline line has already been trending up. So that's for instance. It used to mess me up a lot because I would look at the advanced decline line, and it would be higher than yesterday, even though the futures was making a new low. And it took me quite some time to understand that the advanced decline line actually leads the futures market by a good day to 2 days.
Some traders do homework after hours, some don't. But I asked Charles what he looks at after the market closes to prepare for the next trading day.
It doesn't take me as long as I used to because I know what to look for, but I really just study the 30-minute chart. Sometimes I'll also look at on the cash market, the cash S&P 500 chart. I will look at the daily chart, and I'll see where is the market in relation to the monthly open. Let me list all the highs and lows I look at. On the 30-minute chart, I look at the highs and lows of the equilibrium zones. I look at the high and low of the overnight market. I look at the previous day's high and low. And I also look at the 9:30 Eastern Time open line. These prices will typically act as support or resistance for the futures market. Just from experience, I've observed that. And those are the lines where when a market approaches them, I start to pay attention. I want to see if the market's going to bounce off of them or trade through them, and that will determine how I will enter a trade. For some reason, like the monthly open price, the market will trade away from it in one direction or another, and a lot of times in the middle of the month, it will come back and test that open price again. And again, it will either bounce off of it or trade through, depending on the type of market you're in. For some reason, it will act as support or resistance from time to time.
Finally, Charles talks about how he uses the VWAP, or volume-weighted average price, as a line to help him decide where his entry points and stop losses can be set.
And I usually started around 9:30. On some charts, I started at 9:30. Other charts, I started at 3 o'clock in the morning because that's when the Europeans start trading. That line is typically important on strong trend days. On strong trend days, you'll find that line will act as support or resistance because that's where large firms typically will enter their orders for clients. The traders in large firms, I'm told, are usually judged by how close they enter the orders for the clients, how close to that line they are.
Charles then goes into his methods for determining how many contracts he'll buy or sell on each trade, how he recovers from a series of bad trades, yeah, even great traders have those days, and his specific methods for training his brain to see patterns on the 30-minute E-mini charts. I interview a trader like this one every week, and I'm constantly picking up a new idea or a new way of looking at the markets. I know you will too. Scroll down and you'll see the sign-up form there. Join now and you'll have full access to this interview as well as the transcripts. Good luck in your trading.